Welcome to Beginner's Course Remastered, Lesson 6, Timeframes. Alright, timeframes is a very interesting topic. It is the combination of things and the tearing down of those same things across our chart. You have the 1 minute time frame, the 5 minute, the 15 minute. You have an hourly time frame, a 4 hour, a daily, a 12 hour, which is half of a daily, a weekly time frame, a monthly. And this is the combination and the building and tearing down of all things greater and lesser than themselves. So, for example, if you had a 1 minute candle, well, 5 of those 1 minute candles equals one single 5 minute candle. Or if you were to break down that 5 minute candle, you'd have 5 1 minute candles. Alternatively, if you were to start stacking these candle time frames together, a bunch of 5 minute candles would equal a 15 minute, and a bunch of those would equal an hourly, and a bunch of those would equal a 4 hourly. Well, this is very cool and unique. This is one of the greatest things about day trading and a subject that goes way beyond the beginner's course. Actually, it goes so far past the beginner's course, it's in the most advanced material that I have. When you look at time frames, you can start to understand the strength or the weakness of a move. You can see how many 15-minute candles it takes to create one 4-hour chart, which would give you a good understanding of, hey, a 4-hour chart would be 4, 8, 12, 16 15-minute candles. Wow, that's a lot of candles that it takes to make a 4-hour candle. While that 4-hour candle would therefore have that same reflected strength. Or if you broke down that candle of 4 hours, you'd have a bunch of minuscule time markers on your chart that actually allow you to start to see how a move breaks down and where its reaction points are. So we're getting a bit far ahead of ourselves here for the beginner's course. But this is very important to understand. The importance of time frames goes well beyond this lesson. So let's rewind the clock a bit here. As we are getting very deep into timeframes, I think you can see the importance of how these timeframes work just with that previous statement. The thing that we need to know about timeframes is how they interact with levels as a beginner trader. The interaction of time frame with levels is very cool because you'd have a 15-minute time frame, and that will give you a 15-minute level. Well, you can start to think of this as that 15-minute level as kind of a barometer of strength. If you were to compare a 15-minute level to a 4-hour level, well, I think it's safe to say that that 4-hour level would just be that much stronger. So you can kind of use this as a scale to understand the strength of levels. So that can start to give you a barometer of strength and kind of a relationship between these different levels. And when you're marking levels out, you can kind of start to create a hierarchy in your mind of, okay, this is a daily level. It's going to be fairly strong. Oh, maybe this is a weekly level. That's going to be even stronger. Oh, this is only a 5-minute level. Well, I don't think it's that strong. However, those low time frame levels are still important. You can't disregard them just because they are a low time frame. They simply have their own time and place, again, which we'll get into in later courses, but we are just starting to understand timeframes and their relevance to our charts. So I think there's a lot of really interesting examples that we could go over, but for the beginner's course, we're just going to go over two. Number one is where you would mark these levels based on timeframes. And number two is how you would treat a position. So maybe you're scalp trading, position trading, or swing trading, any one of these three, and how you would treat that versus the timeframes you're looking at. So again, we're just going to start to understand and grasp how we use timeframes with levels. The first one we're going to tackle is using timeframes with scalp, swing, and position trades. So if you are scalp trading something, you may want to look at a variety of different timeframes. You may want to start by looking at your highest timeframes to mark levels to see how strong they are and how likely they are to hold. And then you might want to use lower timeframe candles as well to kind of coordinate some commonalities there. Maybe you had a 4-hour level, and there's also a bunch of 5-minute levels and a 15-minute level, all kind of in the same region. Well, that would be a great spot to take a trade. You would have a combination of levels, which would give it kind of more strength as you're hitting all the levels within one time frame. Now, let's stop there for a second. There's kind of a key piece of information. If you had a 4-hour candle on your chart and you marked it as a level, well, you could dissect that 4-hour candle and go inside there and mark maybe a 15-minute level, an hourly level, and a 5-minute level, and maybe even a 1-minute level. And if all of those got hit within the same time frame, while still staying kind of respectable to the 4-hour time frame, not going too far or too deep into it, or maybe it does go really deep into it, but it hits all those levels. Well, I think these are very interesting spots to start thinking of when you're talking about levels and buying. You could take that 4-hour level and add a bunch of these combinations to it. And if it's going to hit them all, well, maybe that would be a great spot to buy. I think this is a very interesting and unique way to look at levels. Now, that's great for scalp trading because You're using all your time frames to your advantage and you may be in and out of these trades very quick. Well, what about if you wanted to get into a swing position? Well, I think you should still have that same kind of ideology in your mind. I think you still have those same practices where you can dissect these candles and move down into them to find these very interesting spots. However, you're not getting out of the trade so quick. As a swing position, you may want to adjust your base candle as something stronger. Maybe on a scalp position, you could go all the way down to a 15-minute candle or even a 1 hour candle to do that same kind of breaking down of levels. You could also do it with a 4 hour candle, like we just talked about. But with a swing position, you'd be more inclined to stay to those higher time frames. You'd be more inclined to stay above the hourly candle. You wouldn't want to go down into 15-minute candles, 1 minute candles, 5 minute candles. You would probably want to stay within a reasonable amount of 1 hour, 4 hour candles, maybe even the daily candle. Now, for a position trade, again, it's the same kind of thing. You're just getting into larger and larger and longer time frame trades. So if you're going to use the idea of doing a position trade, again, you'd want to stay within bigger time frames. So instead of going all the way down to the hourly, well, you may want to just start with a 4 hour and dissect those larger candles that can show you a larger trade. The nature of them is that they are simply just going to be stronger due to their creation, which is a higher time frame candle. So it's going to allow you to enter a position trade maybe a little better into a stronger area where a candle may be more likely to hold over a longer period of time. So now let's go into an example of how to actually mark these levels and navigate through our time frames. So what you're going to want to do first is just kind of find your highest time frame that you want to start with. In this example, we're going to go with a 1 or maybe a 4 hour candle. We're going to simply mark the level that we think is interesting based on that candle. And we want to find an interesting candle to begin with. We don't want to just mark any 4 hour candle. We want to mark one that's either the height of a move or the bottom of a move. So we're going to start by marking that. Then we're going to go and we're going to start to pull apart the timeframes, dive deeper into it, and see what else is interesting in there. As we dive deeper into it, you can see that there's other points that are very interesting. You have your initial 4 or 1 hour candle. You have pulled it down into a lower time frame, and you can start marking those high moments and those low moments as you continue to go through this on smaller time frames. Now, after we do those smaller time frames, we can even go one layer deeper and mark even smaller time frames. And you could continuously go into smaller and smaller and smaller time frames. The point being is you kind of want to start with the highest candle time frame that you're willing to use first, and then break it down into smaller ones. People who do it the other way get it wrong and they mismark levels. So if you wanted to look all the way down to a 1 minute candle, well, you could start with a 4 hour candle. You could start with a daily. You just have to do more work as you move down through the layers of time frames. You're pulling apart more and more data as you go again deeper into these time frames, or as you compile a higher time frame candle. So if you were to simply start with the hourly, you wouldn't work up to the 4 hour. You would just work down from the hourly. If you were to start with a 4 hour, you wouldn't work up to the daily. You would just work down into your hourly candle, your 15-minute candle, your 5 minute, and your 1 minute candle. And those are the ones I would recommend people use. The 1 minute candle, the 5 minute candle, the 15-minute candle, the 1 hour, the 4 hour, and the 1 day. You can also use the weekly candle, but now you're getting into a much, much bigger type of move and a much different type of strength of something that we'll cover in later courses. So that's it for timeframes. It's a very cool way to start working on the conceptual layers of day trading, where you have kind of this strength relativity of a larger candle being pulled apart into smaller pieces, or smaller pieces all being built like Lego blocks into a big tower. It's a very, very cool piece of information that you can use. Now, in the original course, we talked about momentum and volume, but I'm going to cut that out because for brand new traders, it kind of really doesn't make sense to talk about momentum and volume. Here's a pro tip for you. As you get better and better and better as a day trader, momentum and volume actually don't mean anything. People who read into volume on charts, well, they're simply just trying to justify something that doesn't exist. Momentum and volume aren't something that's used at the highest level of day trading. So why teach it in the beginner's course as a founding piece? What I will tell you is to completely avoid it altogether. Order books, momentum, volume, these things, they don't mean anything. They are just falsifications on the chart that people try to cling to. So don't use them, remove them out of your repertoire. We will never be adding them to our repertoire. And this will save you a ton of information in the future and a ton of mind space that you may have filled otherwise with all these things about momentum and volume and grasping at kind of concepts that don't really make sense. In the next lesson, instead, we're going to talk about level adaptation and how you can start maneuvering these things as a move goes on.